In highly leveraged derivatives markets, price action doesn't wander randomly. Price is structurally pulled toward dense clusters of forced liquidations. Institutional market makers operate at a scale that standard retail volume cannot support. To execute massive positions without severe slippage, they require deep, concentrated pools of forced market orders. To see exactly how this trap is set and sprung, we are going to trace a precise 96-hour window of Bitcoin order flow, from July 14th through July 17th, 2026. We will use a liquidation heat map to track this. This is a visual model that calculates estimated forced close price levels, deriving them from open interest and leverage profiles across the market. The y-axis maps exact price levels. The horizontal color bands indicate where the danger lies. The brighter and more intense the color, the denser the pool of pending liquidations. Those bright yellow and high-intensity green bands mark massive concentrations of over-leveraged counterparties whose positions will be forcibly closed if the price reaches them. By identifying these vulnerabilities before they are triggered, we can map the exact architecture of market gravity long before the price actually moves. Let's start the clock at midnight on July 14th. The market is in a ranging environment, quietly accumulating tight leverage on both sides of the current price. This chart shows resting order flow at our window start. Notice the intense yellow liquidation band sitting at the 62,000 support level. Watch the market price wick down to pierce that threshold, triggering forced sells, followed by an immediate upward rebound candle. That localized sweep instantly provided the counterparty liquidity that institutional buyers needed to fill their orders without pushing the price up against themselves. This visual tracks the market over the next several hours. The price moves sideways, consolidating securely between two prominent yellow bands, with that bottom threshold remaining intact. These localized sweeps act as the structural breathing of the market. They generate the necessary fuel to support the next major directional move. On July 15th, the momentum shifts aggressively. This heat map captures a large green candle breaking out, pushing the price vertically toward the 66,000 level. This rally triggers a predictable side effect. Retail traders enter late, applying heavy leverage to chase the trend. Look at the risk. A thick cluster of yellow and green bands stacking directly beneath the current price, filling the gap between 63,500 and 64,500. Throughout the day, as the high price holds near 65,000, this chart reveals those lower bands stratifying and intensifying. The resting liquidity pool is solidifying. This creates a mechanical trap. The higher the price climbs without a standard correction, the heavier and denser the trapdoor beneath it becomes. The structural vulnerability is now locked in. The market awaits only a catalyst to trigger the release of that stored downward pressure. Moving into July 16th, this visualization shows the price hovering and repeatedly failing to break the upper resistance above 64,500. Then comes the decisive rejection. We see a distinct downward price break, heading straight for that heavy yellow band sitting at 64,000. This activates the market's gravity. Lacking willing buyers at the top, the matching engine naturally seeks the path of least resistance, accelerating toward the densest liquidity pool at the bottom. By the late hours of July 16th, the chart shows a final sequence of red candles being dragged down, closing perilously close to the 64,000 line. When a market exhausts its upward momentum, it does not slowly glide down. It is actively pulled down by the gravity of resting leveraged orders. We have now reached the cascade trigger, the precise moment the price crosses the threshold of the first major yellow band and initiates a chain reaction. On July 17th, the chart captures this extreme violence. Notice the sharp, uninterrupted sequence of red candles plunging rapidly through 63,000. The mechanics are brutal. The first triggered liquidations execute as forced market sells. These algorithmic sells instantly push the price down further into the next band, triggering a fresh wave of liquidations. Watch what happens to the heat map as the price bottoms out near 62,500. Those previously bright yellow bands are completely consumed and erased from the board as the price wicks through them. Once the liquidity pools are entirely swept, the structure resets. The chart shows the price action immediately flattening and stabilizing within the empty dark space where the leverage bands used to reside. This drop was the blind, mechanical execution of stacked vulnerabilities clearing themselves out, operating independently of retail sentiment or external news. Compare the peak leverage accumulation from July 15th on the left to the post-sweep reality on the right. The dense structural vulnerabilities have been wiped completely clean. Institutional algorithms treat these liquidation zones as raw fuel, utilizing the forced volume to satisfy their own large-scale execution needs. Our 96-hour data proves a continuous four-stage cycle. First, accumulation of leverage. Second, gravity hunting as momentum stalls. Third, the liquidation cascade. And finally, the reset. Because high leverage clusters represent the only guaranteed forced liquidity pools in the market, their destruction is an operational necessity for large players. This quantitative reality exposes why standard retail technical analysis often fails. Arbitrary diagonal trend lines offer zero protection during a liquidity sweep. True market support and resistance are fluid, dynamic zones, mapped strictly by the resting location and the density of over-leveraged counterparties. The liquidation heat map provides the predictive architectural blueprint of market gravity. To trade profitably at an advanced level is to align execution precisely with the inevitable mathematics of the liquidity sweep.